Hey everyone, SoFi Technologies is scheduled to report second quarter 2024 financial results on Tuesday, July 30th before the markets open. So there's a lot to look for from SoFi Technologies when it announces earnings. I'm going to discuss several of the big picture items to look for when the company announces its financial results in this video. I'm also going to let you know if you should buy SoFi stock before earnings or after earnings release, or if you should buy SoFi stock at all. So I'll answer that question as well. So there's a lot to cover, so let's get right into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so in their latest quarterly update, SoFi Technologies CEO Anthony Noto said that financial services and tech platform segment revenue grew 54% combined and represented 42% of consolidated adjusted net revenue, offsetting flat lending revenue given a more conservative approach in light of macroeconomic uncertainty. So two things to unpack here. Number one, financial services and tech platform revenue. Investors of SoFi stock should look for these two to grow to a larger proportion of the company's overall revenue. These sources of revenue are less risky than the lending revenue because the company is not taking on risk of defaulting people that don't pay them back for the loans that they make. Tech platform and financial services revenue also have the opportunity to be more profitable in the long run, whereas lending revenue doesn't have that kind of scale to generate those high-level profit margins that financial services and tech could offer, right? Potentially. They're not there yet, but they have that upside where longer term they can provide better upside than the lending side of the business. Okay, that's the one thing. The second thing, flat lending revenue was on purpose. The management team coming into 2024 was still concerned about an economic slowdown. They were approaching this year on the more cautious side. And so they said they're going to purposely decrease lending and be more selective in the loans they make. And so that's leading to lower lending revenue. This was an approach that I felt was prudent from SoFi because of something I'll discuss a little bit more later, which is that the portfolio of loans they have right now are on the riskier side. Even though I understand that they attract higher credit quality borrowers, the types of loans that they're making, the personal loans, are on the riskier side of all types of loans you can make. So I'll talk a little bit more about that later. So one of the things I've liked about SoFi in recent quarters is the big improvements in profitability. And while adjusted net revenue increased by 26% in their latest quarter, which ended March 31st, adjusted profitability, or EBITDA, earnings before interest, taxes, depreciation, and amortization, increased by 91%. What's more, management has talked optimistically about their profit forecasts going forward. I'm going to look for continued optimism regarding their profitability, and I want to see what management says about how 2024 has played out so far in terms of the macroeconomic uncertainty. Are they still as cautious as they were to start the year, or have they noticed an improving scenario, and are they going to be less cautious now? I'm interested to hear from management and what they think. Another big item to look for from SoFi is total deposit growth. Now, it grew to a record $3 billion in the latest quarter, which was up 16% year over year, and they now have $21.6 billion of customer deposits. And over 90% of that are SoFi money deposits, meaning checking and savings accounts that come from direct deposit members. Direct deposit members are more valuable than any other kind of bank member because they're stickier. Think about the process you have to go through to set up direct deposit. There's paperwork you have to fill out with your employer. There's paperwork you have to do with the bank that you're signing up with. And so customers don't like to do this very often. If they join a certain bank with direct deposit, they're likely to stick around longer term unless there's a big reason for them to switch. Right now, SoFi is creating that reason for customers to switch from companies like Bank of America and Wells Fargo by offering a better website and app and a better deposit rate for their checking and savings. Also, if you sign up with SoFi, they'll offer you a couple of $100, upwards of $250 if you set up direct deposit. So they're creating a reason for people to switch, and people are taking them up on it as they've grown their members and grown their deposits very nicely. I want to see this continue in the update they will provide. So because they're generating more deposits, they can use those deposits to make loans, and that's primarily what SoFi is in business to do. Take customer deposits and make loans with those deposits. And for the foreseeable future, that's primarily where they will generate profitability. And the difference between those two, how much they pay to get deposits and how much they earn to make loans, is called the net interest margin, which was 5.9% in the latest quarter. I want to see where this number moves. The higher this number goes, the better. I want to see an update on this and continued improvements here from SoFi Technologies. So I talked about new members and how SoFi is attracting new customers. I want to see that continue. They added 622,000 in the most recent quarter, and now they have over 8.1 million members, and that was up over 45% from the prior year period. I would like to see SoFi's new member additions continue at this rate when they update investors in their quarterly earnings release. Of course, if this rate of improvement increases, that would be a big benefit for SoFi stock investors. I mentioned there was a lot to talk about from SoFi Technologies, and here's another critical item, and that is the weighted average annual default rate. I've started to hear from several companies that have exposure to loans that default rates from consumers are rising. They're rising, and they're rising quickly, because for the better part of the last 3 years, consumer balance sheets have been very, very healthy because of all the government stimulus that's been handed out. But now we've had some time from the last government stimulus money, and customer balance sheets are not that great anymore. You're starting to see more defaults, and that's a big risk for SoFi, and I want to see this. Personal loans, 4.8% annual default rate. This is the one I'm most concerned about. Student loans, not so much, because the default rate is so low. The weighted average default rate is only 0.6% for student loans. But the personal loans, I highlighted earlier that SoFi has a large exposure to personal loans, and these loans are at risk of defaulting much more than student loans. So let me share with you the total percentage. In the latest quarter, out of the 4.366 billion in loans that SoFi originated, 3.3 billion were personal loans. I'd like to see that percentage diminish. I'd like to see student loans and home loans grow to a larger percentage of their business. Student loans and home loans are less risky than personal loans. As you saw with student loans, the default rate was very low. Home loans are similarly low, but the added benefit of home loans is that it comes with great collateral, and if there is a default, you can recoup some of your investment. So that's why I'd like to see SoFi allocate more loans to students and home loans and less to personal loans. I'll be looking at this metric closely when they report earnings. And finally, I want to look at the outlook for the rest of the year. Management said that guidance for lending revenue would be about 5 to 8% decline in 2024. It seems like they're on pace to do better than that. They noted flat revenue in the second quarter. That means it didn't decline. They were forecasting a decline 5 to 8%. Are they going to update this and tell us, okay, it looks like 2024 is better than we expected. We no longer expect this 5 to 8% decrease, but we expect it to be flat. That would be a big positive. I'm looking for some kind of upgrade here because of so far 2024 looks better than what management was expecting. And then I want to look at their profitability outlook. So they now expect full year GAAP net income of 170 million at the midpoint. That's way above the 100 million they forecasted to start the year. Do they still think it's going to be on pace for 170, or are they upgrading that now that the year is going better than expected? So I want to see this as well. All right, so those are the big picture items I want investors and what I'll be looking for from SoFi. Now to answer the question about buying or selling before earnings. SoFi stock is trading at a forward price to earnings of 36. And given their earnings prospects and the earnings growth expectations over the next 4, 5, 6 years, I think the stock is undervalued at this price. So if you want to buy SoFi stock, the least risky way to buy it would be to do half before earnings and half after earnings. If you want to take a little more chance and you don't want to miss out on a potential rise, you can buy it ahead of earnings. But the less risky way is to do half and half. I don't feel SoFi stock is undervalued so much that it would require you to get in ahead, rush in before earnings release, right? I don't feel that with SoFi. I said it's undervalued, but I don't think it's so much undervalued where the benefits of doing half and half are outweighed by how undervalued it is. So I don't think it's that much undervalued. So to answer the question, I mean, you could buy it before earnings. That wouldn't be a terrible decision. I do have the stock rated as a buy, but the less risky way to do it would be to do half before and half afterwards. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.